Public spending pressures from increased defense requirements and the rising economic and fiscal impacts of population aging and vulnerabilities associated with high financial asset valuations, such as for AI-related investments and cryptocurrencies. We now project global GDP to grow by 3.2% this year, which is only slightly below the 3.3% rate of growth achieved last year. For next year, global growth is expected to moderate slightly to 2.9% as higher tariffs in the United States and China raise business costs, reducing growth in trade and investment. For 2027, we project a small rebound in growth to 3.1% as the peak impact of higher tariffs passes and inflation declines. OECD countries are growing at around half the rate of global growth, while economic convergence elsewhere, especially in emerging Asia, remains the main driver of global growth. Activity in the technology sector has been strong, boosted by sharp increases in investment in AI and other digital technologies, with industrial production of computer and electronic products having increased much more than total industrial production across countries and regions. In the United States, technology investments are driven in particular by imports of information and communication technology products were a key driver of economic activity in the first half of this year. Fiscal and monetary policies have helped sustain activity. OECD's country's primary deficit, that is a government's fiscal deficit excluding spending on interest payments, continues to be significantly higher than in 2022. Monetary policy has eased in most advanced economies over the past year, which has lowered bank lending rates for firms and households, supporting credit growth. The average legislated tariff rate on merchandise imports to the United States is now estimated at 14.9% in November, markedly up from 2.3% in January, but down from the 16% in September as a result of several new trade agreements. The full effects of those higher tariffs since the start of the year will become clearer as firms run down the inventories that they built up in reacting to the tariff announcements earlier this year, and as the higher tariff rates continue to be implemented. So far, our estimate of the tariff rate that is actually being applied in the United States, based on the latest available reported customs duties and import statistics, is below the legislated rate, which suggests to us that tariff collections are likely to rise in the months ahead. Labor markets continue to be relatively tight, though there are some signs of easing. Job vacancies have fallen back to their pre-pandemic levels of 2019. Still, the unemployment rate across the OECD was 4.9% in the second quarter and 5% in September, only slightly up from its record low of 4.8% back in June 2023. Our projections point to a moderation of global GDP growth to 3.2% this year and 2.9% next year, followed by a small rebound to 3.1% in 2027, as I already mentioned. But compared with our economic outlook from June, these projections are up by 0.3 percentage points for this year and unchanged for next year. Highlighting some country-specific developments, in the United States, growth is expected to slow from 2% this year to 1.7% next year as higher tariffs take full effect, while for 2027 we project a small pickup to 1.9%. For Japan's economy, we project robust growth of 1.3% this year and 0.9% in both 2026 and 2027, supported by resilient domestic demand. In the euro area, growth is projected at 1.3% this year, 1.2% next year, and 1.4% in 2027, as increased trade frictions are expected to be offset by capital spending from the Recovery and Resilience Facility and higher defense expenditure. China's growth is projected to slow from 5% this year to 4.4% next year and 4.3% in 2027 as a result of the impact of higher tariff rates on exports to the United States, as well as continuing adjustment in the real estate sector and fighting fiscal support. Inflation is expected to continue to decline progressively. For the OECD, we project inflation of 4.2% this year, going down to 2.8% in 2027. One exception is the United States, where we expect tariffs to push up inflation from 2.7% this year to 3% next year. By the middle of 2027, inflation is projected to return to the central bank's target in most major economies. This outlook remains fragile with significant risks. The outlook for trade and trade policy is particularly uncertain. Import restrictive measures on goods introduced since the beginning of 2009 are estimated to affect 16.8% of world imports, up from 0.6% in 2009 and 2.8% in 2016. Additional trade barriers would lower growth prospects further and likely push up inflation higher in countries imposing tariffs. But on the upside, of course, measures to lower trade barriers and reverse tariff increases would improve sentiment and support stronger activity. Another key concern relates to the resilience of global supply chains, given the high level of concentration in production of some key inputs, including rare earths and critical minerals. For example, China accounts globally for more than 50% of all rare earth mining and lithium, and more than 90% of all magnet manufacturing and graphite. A sudden disruption in the supply of these key inputs could lead to output drops in sectors such as energy, AI, and information and communication technologies, defense, and automobiles. Higher spending needs arising from defense requirements and population aging are also increasing fiscal risks. NATO countries plan to increase their core military spending to at least 3.5% of GDP by 2035, and population aging is set to increase old age dependency ratios across OECD countries significantly, from 33 adults aged 65 and over for every 100 people of working age today to 52 people 65 and over for every 100 people of working age. So that is more than half of people above age 65 for every 100 by 2050. And the economic, social, and fiscal impacts are significant. This year's OECD employment outlook estimates that the fall in employment due to population aging will reduce the level of per capita GDP in 2060 by about 14%. That is under current policy settings. And in terms of fiscal impacts, our assessment is that the decline in economic growth due to population aging would cause tax revenues in 2060 to be around 14% lower than they otherwise would have been, with simulations based on the OECD long-term model finding that without policy measures, higher spending on pensions and health due to population aging will push net government debt across the OECD from around 75% of GDP today to 230% of GDP by 2060, compared to 150% as a share of GDP without the impact of population aging. Asset valuations, especially of US technology companies, are high, reflecting strong optimism about AI and its potential productivity gains. Since 2020, forward earnings have risen 3 times as fast in the technology sector as in other sectors. If these expectations materialize, economic growth could be higher than in our projections, but in contrast, should the gains from AI be smaller than expected or delayed, a sharp asset repricing could occur. The size of non-bank financial institutions such as insurance corporations, pension funds, hedge funds, and investment funds has risen significantly over these past 2 decades. And some of these institutions, including real estate, investment trusts, and business development companies, are both highly leveraged and less regulated than banks, making them more vulnerable to shocks. The use of cryptocurrencies has also increased quite sharply. For example, The transaction volume of stable coins more than doubled from 2023 to 2024. Stablecoin issuers have become major holders of US Treasury bills. A potential market disruption or turn in investor sentiment for cryptocurrencies may lead to a sell-off of Treasury bills, straining government bond market liquidity. Turning now to policy priorities. Constructive dialogue between countries is central to ensure a lasting resolution to trade tensions. All other things being equal, well-functioning, open global markets mean better living standards and stronger growth. We need to continue to draw on these very real benefits while tackling genuine concerns around unfair trade practices and unlevel playing field, supply chain resilience, in particular on key strategic product lines, and more generally, economic security, which is why our strong advice to all government remains to work harder, work together bilaterally and multilaterally to find the best possible ways to make our international trading arrangements fairer and function better in a way that preserves to the greatest extent possible the economic benefits of open markets and rules-based global trade. Our model simulations highlight the benefits. A broad-based global decline of tariff rates by 1.5 percentage points could boost global GDP by almost 0.3% by the third year, while also lowering annual inflation in the global economy by more than 0.2 percentage points in the first 3 years. Central banks must remain vigilant. Continued rate cuts are appropriate where inflation is firmly at or returning to targets, yet central banks need to be ready to adjust in case of renewed inflationary pressures or unexpected labour market weakness. Most major advanced economies are expected to continue to lower rates or hold rates steady over the next few quarters, with the exception of Japan, where the policy rate is projected to increase from 0.5% to 2% by the end of 2027 as inflation becomes more firmly anchored at the central bank's target. With the importance of non-bank financial institutions rising, private credit, that is lending by non-banks to households and firms, has expanded quite significantly to around 11% of bank corporate loans last year. Financial regulators should ensure effective oversight of non-bank financial institutions through timely data collection and by stress testing to identify exposures and mitigate systemic risks. Fiscal discipline is necessary to tackle high and rising public debt and to maintain and to rebuild fiscal space to react to future shocks as well as fiscal structural pressures, structural spending pressures. Last year, public debt in the OECD stood at 111% of GDP, which was up from 73% back in 2007. And over the same time span, public debt in G20 emerging market economies rose from 54% to 70% of GDP. Costs of servicing public debt are also on the increase. Government interest payments increased as a share of GDP in about 2/3 of OECD countries, reaching 3.3% on average in 2024. Fiscal plans should focus on controlling growth in expenditures, improving spending efficiency, better targeting of social benefits towards those in need, and reallocating spending to areas that better support opportunities and growth. Ambitious structural reforms are essential to unlock stronger prospects for economic growth. Potential GDP per capita growth in the OECD is estimated at 1.4% this year, which is down from around 2.2% in the late 1990s. Job creation has been boosting growth in recent years, while the contributions of productivity growth and especially investment have declined significantly. Regulatory policy reforms, the subject of this Economic Outlook's special chapter, can be an especially powerful driver of stronger growth. For 37 of the 55 countries in the Outlook, reducing red tape and simplifying regulations is a key priority. Reforming regulatory design and oversight and lowering entry barriers in services sectors in particular are two other policy priorities that are relatively common across countries. New OECD empirical estimates highlight the significant economic gains from easing regulations. For example, bringing regulations on retail trade in line with the 3 OECD countries with the most competition-friendly regulations would help boost labor productivity by up to 2.3% across OECD countries over the long term. And less strict regulations of professional services would help raise labor productivity by 1.6% on average. In conclusion, the OECD economic outlook that we're presenting to you today projects a relatively mild negative impact of recent trade shocks and elevated uncertainty on the global economy over the next 2 years, though fragilities are significant and growth will remain low by historical standards. In order to lift economic growth and durably strengthen incomes and living standards, countries will need to respond quite decisively and in a cooperative way, tackling underlying risks, maintaining fiscal sustainability and advancing structural reforms. Thank you for the opportunity to present this latest outlook to you, and I now hand over the floor to Assa and Luis to deal with some of the more detailed questions.
Thank you, Secretary General. I'd just like to remind journalists following us online they can ask questions using the chat function. I'll ask Assa and Luis to go to the stage. And just to repeat, Assa Johansson is Director of Policy and Research. Angel Calvo from
Yes, hello. Can you explain why you are less pessimistic than in September and in June on tariffs, on the effects of tariffs, especially in the US?
We have seen the effect of tariffs being less strong than what we estimated in June and in our September outlook, and that comes for a couple of factors. We have seen that firms that are using inventories and stockpiles to offset some of the effects of the tariffs. They are also using the profit margins to buffer some of the price increases. And we also know that there is a time difference between the implementation of a tariff and when it's announced, as well as some of the goods that are in transit are accepted from the tariffs. At the same time, we've also seen that the countries have taken supportive policies. As the Secretary General mentioned, there have been supportive macroeconomic policies. And we've also seen there's been a boom in investment related to AI. So those are factors that are offsetting the effects of tariffs on our projections. Thank you.
Thank you. Do we have any more questions in the room for now? We have a question from William Horobin from Bloomberg, who asks, we have 2 questions. Since the interim outlook in September, you revised up US and Euro area growth forecasts. Could you go into more detail on the reasons for this?
Yes, the upgrade of the forecasts have to do with how those economies are behaving, the type of underlying pressures that we have that have been somehow offset by the dynamism of domestic demand. Take, for example, the case of the US. We know that tariffs, we know that policy uncertainty, all that has depressed economic activity. On the other hand, we see the dynamisms of investment. In the US, investment related to the AI, everything that has to do with CAPEX, with infrastructure developments related to data centers, everything has to do with firms purchasing equipment that will allow them to thrive in this new technological age. All that has lifted economic activity in ways that have somehow offset some of the negative impacts related to policy uncertainty and related to the effect of tariffs on economic activities.
There is an upgrade in the global economic growth, but it's not seen because it's very small, so it's a rounding issue. So the answer to the question is quite technical. I hope that satisfies the answer. Thank you.
Okay, thank you, Asa. We have a question from Paolo Levi from the Italian news agency ANSA. Growth in Italy looks very low. What is your main suggestion to the Italian authorities to improve the situation?
Indeed, growth in Italy has been low for a number of years, and we've been documenting the fact that in Italy, like other advanced economies, productivity growth has been much more subdued than we would expect, and much more subdued than needed to ensure the type of growth that we want over longer periods of time. We see the Italian economy as having been affected negatively this year in terms of domestic demand, given all the policy uncertainty that we're seeing around the world. We are seeing also that investment has been relatively weak for the same reasons. We find it important for Italy to maintain the path of consolidation of the public finances that is so important for a country that has high levels of debt, such as Italy, but we also see a lot of opportunity for structural reforms that would lift Italy's potential growth rate and then help not only with improving the living standards of the Italian population, but also helping consolidate the public finances as well. Issues that have to do with bringing more people to the labor force. In Italy, we see labor force participations of young workers, of older workers as well, as having a lot of potential to increase. In a population that is aging as fast as Italy, it will be very important to make sure that all the talent that is available is actually used to sustain growth over longer periods of time. Issues that have to do also with investment, investing in infrastructure, in the green transition, are all options that could improve the performance of the Italian economy and then yield higher rates of growth over the medium term.
Thank you, Louise. We have a question from Henry Saker Clark from The Independent in the UK. How does the OECD think the UK government tax increases for Wednesday's budget will impact the country's growth outlook?
The UK economy, we all heard last week the new budget. The new budget has a consolidation path that is somewhat more backloaded than we had expected. There are increases in spending that are relatively front-loaded. There are increases in taxation that will allow for the consolidation of the public finances, but they are somewhat more backloaded than we had expected. So all in all, it is a budget that will allow for the continued consolidation of the public finances in the UK, the reduction in debt over time, which is so important not only for the UK economy, but also it's also the case for other advanced economies. But we cannot lose sight also of the structural reforms that, again, as in the case of Italy that I mentioned before, but also in the case of the UK, can play a very important part in lifting growth rates over time. In the case of the UK, all the effort that has to do with deregulating, reducing the burden on enterprises, facilitating the process of permitting and licensing for new investment, all that has a huge potential to make sure that the business sector in the UK is more dynamic, that growth becomes stronger on the back of greater efficiency in the private sector.
Thank you, Louise. We have another one here. You talked about the importance of fiscal sustainability in the presentation. How should countries balance the need to address the mounting public debt ratios while supporting new spending needs?
So what we emphasize in our general assessment and more broadly is that it's important for countries to ensure long-term debt sustainability, as this is important because if debt becomes too high, countries are spending too much of their income or revenues on servicing the debt rather than spending on priority areas such as aging, health, defense, and other needs. So what we're saying, it's important for countries to work on constraining spending and also prioritize spending to the areas that are greatest in need. And this can be done with help of medium-term fiscal plans, and strong fiscal institutions is important in this area. Another thing that we're saying in some cases is maybe necessary to raise more revenues. And if this is the case, it needs to be done in a what we call in a growth-friendly way, so not to affect incentives of firms to invest or for households to work. So that is an important thing to look at how you raise your revenues. So it is a mix of things that countries can do, and it's going to be depending on the country context. But the main message that we have is it's crucial to put debt on a long-term sustainable path. Thank you.
Thank you, Asa. We have a question, I think this is for Luis. Why is the Spanish economy growing so strongly despite having not had a budget approved for 3 years?
Spain has had very strong performance over the last few years. So if you look at the numbers for Spain since the pandemic, the energy price shock, the Spanish economy has behaved rather well. The domestic demand has been strong, wages have increased, not only in nominal terms, but also in real terms. That has provided a very important lift for consumption. Investment has been supported by European funds, but also there has been a lot of recent dynamism in many sectors of the Spanish economy. What is important to bear in mind in the case of Spain as well, is that a lot of the growth in previous cycles had to do with how more people joined the labor force, how jobs were created, how much employment came on stream as a result of economic growth in this push in aggregate demand. What we are seeing now in Spain that is very important is also an increase in productivity. Since the pandemic and the energy crisis, if you look at the general numbers of aggregate productivity levels in the Spanish economy, that has been fairly robust. And that's an important new element that I think is a result of all the reforms that had been implemented in the past, some other dynamics in the Spanish system, shifts in the demand for Spanish products in foreign markets. So a number of factors that make for a very good near-term outlook for the Spanish economy. What is important is to make sure that action happens on two fronts. One, all the structural reforms that are needed to maintain that impetus in growth, and at the same time to continue to consolidate the public finances.
Thank you, Luis. We don't seem to have any more questions online. Do we have any more questions from journalists in the room before we close? No? Okay. Well, in that case, thank you very much, Luis. Thank you, Asa. Thank you, Secretary General. We'll close there. Thank you. you.